62% of Americans own stocks. That sounds like a lot until you learn that the bottom half of that group owns just 1% of all shares. The top 10% own 87%. This is not a wealth gap caused by income, it's caused by asset ownership. Today, on the Income Mission, I'm going to show you 7 assets actually making ordinary people wealthy in 2026 in the exact order to buy them based on how much money you have right now. Before the 7, here's a fact that changes how every asset on this list works. The IRS treats investment income completely different from work income. Someone earning $50,000 at a job pays 22% federal tax. Someone earning $50,000 in qualified dividends could pay 0. Same money, wildly different tax bills. That's not a loophole. The tax code was designed to reward people who own assets over people who trade hours for dollars. Once you understand that, everything I'm about to show you becomes significantly more powerful. Asset number 1, S&P 500 index funds. One fund that owns a slice of the 500 largest companies in America. The 100-year average annual return is 10.46%. Annual fee is 0.03%. $500 a month for 20 years at 10% returns builds $378,000. If you hold it in a Roth IRA, every dollar of that growth is taxed at 0%. Warren Buffett's will instructs that 90% of his wife's inheritance go into a single S&P 500 index fund. Not individual stocks, not real estate, not gold. If that is good enough for the greatest investor alive to leave his family, it's good enough to start with today. The S&P is down over 6% so far in 2026. Most people see that number and feel fear. Experienced investors see a discount. Asset number 2, rental property. Real estate investors bought 30% of all single-family homes in 2025. Corporations own nearly 9% of all residential land and could control 40% of rental homes by 2030. They're not doing this because real estate is a bad investment. They're doing it because it's one of the best. The question is whether you get in before they buy everything up. Cash-on-cash return in 2026 runs 8 to 12%. Properties in best cash flow markets can generate over $1,000 a month net. And when you lock a fixed-rate mortgage and inflation rises, your debt gets cheaper in real terms every year. The bank loses purchasing power, you gain it. Minimum entry is $15,000 to $60,000 down and active management. Fastest wealth accumulation asset on this list. But what if you do not have $60,000? Enter house hacking. By buying a duplex or a triplex using an FHA loan, your required down payment drops to just 3.5%. You live in one unit and rent out the others. Your tenants literally pay your mortgage while you build equity. It completely destroys the traditional barrier to entry and makes real estate immediately accessible today. Asset number 3, dividend stocks. Companies that share their profits with you quarterly or monthly just for owning shares. High-yield stocks and utilities, REITs, and telecoms pay 4 to 7%. Here is the tax detail that changes everything. Qualified dividends are taxed at 0 to 15%. Non-qualified dividends are taxed as ordinary income up to 37%. On $50,000 in dividend income, that difference is $11,000 in tax. Same income, massive gap in what you actually keep. Always verify whether a dividend is qualified before you invest. Asset number 4, this is the one your bank's actively hiding from you, a high-yield savings account. Traditional banks pay 0.39% interest right now. Best high-yield accounts pay 4.2%. Over 10 times more for doing nothing differently. Both FDIC insured up to $250,000. Why does your bank pay you almost nothing? Because they borrow your money at 0.39% and lend it out at 6 to 7%. That spread is their entire profit model. Your low rate is not a mistake, it's their business model. $10,000 in a traditional account for 5 years becomes $10,197. In a high-yield account, it becomes $12,293. $2,000 more for 0 extra effort. With inflation at 2.7%, a high-yield account grows your purchasing power. A traditional account is shrinking it every day. If you live in a high-tax state, Treasury bills at 3.72% are exempt from the state and local taxes. Asset number 5, REITs. Imagine owning 500 buildings for the price of a coffee. REITs are companies that own income-producing real estate. They are legally required to pay out 90% of taxable income as dividends. Average yield right now is 3.88%. Most REIT dividends are taxed as ordinary income, not at the lower qualified rate. The fix is simple. Hold REITs inside a Roth IRA. Tax-free dividends compounding for decades. That single placement decision saves you tens of thousands over a lifetime. Asset number 6, gold. Let me be honest about what gold actually is. It returned 8.9% annually over the last 5 years. It outperforms nearly everything during geopolitical crises. But it pays 0 dividends, 0 rent, 0 yield. It does not compound. Gold is not a wealth-building asset, it's an insurance policy. Own 5 to 10% of your portfolio as a hedge. Do not build your entire strategy around it. Asset number 7, digital royalties. Create something once, get paid for decades. The e-learning market is projected to hit $1 trillion by 2032. One creator earned over $80,000 from a single course on Udemy. Margins are 95%. No inventory, no ceiling. This is the only asset on this list where your return has no upper limit. It's determined by what you build, not what you invest. Now, here's the question nobody asks. If all this information is available for free, why are so few people actually wealthy? The answer is not education, it's psychology. Loss aversion makes you feel losing $100 twice as painfully as gaining 100 feels good. So you sell during downturns exactly when you should buy. Status quo bias keeps your savings in a low interest account even though you know a better option exists because doing nothing feels safer than acting. Present bias makes you choose right now over later. $200 a month in subscriptions feels harmless. That same $200 invested for 20 years at 10% becomes $162,000. Your brain's not wired for wealth, it's wired for survival. Building assets means overriding 3 million years of evolution. So here's the asset ladder. Stop asking which asset is best, start asking which one matches where you are today. If you have $0, open a high-yield savings account and put $25 a week into an S&P 500 index fund inside a Roth IRA. If you have $1 to $10,000, max out the Roth at $7,000 a year and add REITs inside it for tax-free dividends. If you have $10 to $50,000, build a qualified dividend portfolio alongside your index fund and reinvest everything. If you have over $50,000, enter rental property and let leverage and tenants build equity for you. And if you have a skill and the time, build a digital royalty stream. No other asset on this list has 0 ceiling. That is the income mission. Subscribe so you don't miss the next one.